Yes, yeah, we have one apparent, two apparently from the vice chair, also to the doctor, and our staff representation will be.
Other minute, do we have any declarations of peculiar interest? Minutes of the previous meeting, are they agreed?
Agreed.
Quarterly performance reviews from Roger.
Thank you, Chair. So this is a bit of an interim update because we brought the meeting to February. So this is for quarter 4, 2025-26. During that quarter 4, the fund's assets returned 2.6%, which is slightly underperforming the benchmarks by 0.2%. But over the longer time periods of 12 months and 3 years, the fund has underperformed the benchmark. But over the last 12 months, it's probably worth marking that the fund has returned 11.2% on its investments, which is a good thing. And over the last quarter, the fund's assets have increased from 1.02 billion to 1.046 billion. We've grown a bit more over that period, and that's up to the quarter to the 31st of December 25. Yeah, so that's a brief summary of our performance today.
Do we have any questions?
Can I just ask Roger the context in terms of other London boroughs? How big are other pensions and how small are the pensions?
I'm going to ask
And should someone read anything into that?
I'd say that the Burton Fund at £1 billion is one of the smaller pension funds, definitely. There's some fairly large ones in London. I haven't got the numbers in front of me. We could provide those to you, Councillor. And then there's obviously relative performance. I haven't got data comparing performance in terms of our again, we can do that. There is some statistics flying around, but we just don't have them with us tonight. But Mesh, you got it?
Yeah, I agree. There is one institution who gather data and produce most likely annual return comparing the funds across all the GPS funds. When that is available, I'll be fixed and see if that comes are included in the future meetings as well.
Thank you.
Okay. Do you want a question? Can you go to the audit results report? Is that nothing okay with that?
So if the committee can remember, EY was at our September committee meeting going through in detail the pension fund audit, but that time was about 80% complete. Now it's fully complete. So that time they issued a draft report. This is a final report, just to note. And also please note this report will be going to the Governance Standard and Audit Committee on Wednesday for the final approval. So I thought it's good that the pension committee see this report, give assurance to the Standard General Purpose Committee so they can approve it. So from the auditor's point, as at now, they have completed the audit and nothing for them to issue an audit opinion. It will be issued along with the main council's policy.
I noticed that they've taken action to some of the recommendations that have been made.
Yeah.
Okay, and then we go on to the triennial valuation of value here.
Barry?
Thanks, Chair. Yes, it's an update on the Boomerang for valuation. We've provided all the contribution rates and funding positions for each of the employers in the fund. That's all been fairly smooth. There doesn't any employers have been back to challenge the results. We issued the draft FSS consultation, which I'll talk a little about in a moment. Just to give you the sort of background to what's different this time. And then the next step will be to the draft formal valuation report, which we'll do over the next few weeks. We'll have that ready by the end of February. And then once that's signed off, which includes the wage adjustment certificate, which sets out the contribution rates for each employer for each of the next 3 years, and that's the end of the project. In your pack, so the draft valuation report isn't there; it's still to be done. But the funding strategy statement is in the pack. I don't know if you want me to do that
Yeah,
briefly. It's a very long document, so I don't intend to go through it in any detail. But just to give a sort of context, so the funding strategy statement, by giving its name, sets out this strategy for funding for all participating employers in the fund. It sets out how the valuation is carried out, it sets out the assumptions, and it sets out how the employer contribution rates are calculated. The funding strategy statement, quite a lot of work done on it this time, a bit of an overhaul, and that was because there was new guidance issued last January, January 2025, sorry, by MHCLG, SIPFA, and the Scheme Advisory Board. And so normally we have to update the funding strategy statement every 3 years as part of the valuation. This time we did a bit of a rewrite because it had to fit into 3 key sections. And the objectives behind the guidance was to, first of all, to write it in plain English so that employers could read it and understand it. Secondly, it was comprehensive, detailed enough that employers could pick it up and work out how we had, and how the fund, with the fund action advice, had determined the contribution rates. And thirdly, those bodies I mentioned were keen to get more engagement with employers. I think in the past there hasn't been a lot of feedback on the funding strategy statement, and so we're keen to try and consult properly. So they're the kind of main objectives behind updating the guidance. So that meant we could set it out in quite a bit more detail. Ironically, this is a good and bad thing. Ironically, because we had to set out, make it a little more comprehensive, it's now very long, which, and given they wanted employers to engage with it, that might put employers off reading it. So that was a bit of a problem, but we tried to put it in sections so that employers could jump to the parts that were relevant to them, because it also talks about how the fund treats employers joining the fund and exiting the fund. So that's another section in there, and it details any policies that the fund has on things like contribution reviews or deferred debt arrangements and so on that would impact employers. So that's kind of the context, the background behind it. In terms of the process, the funds, it's a fund document. We helped draft that though, and then once we're happy with it, then for consultation to employers. They had a few weeks to respond. We only had one comment, which was from the Department for Education, DFE, which wasn't a surprise because they've effectively made the same comments, I think, on just about every LGPS fund. They've got in just because they are acting as a guarantor for the academies that participate in the fund. And they asked the same sort of questions of most of our LGPS funds at BW, around about minimum contribution level and surplus buffers, which we've drafted a response from the MASH to send on to them. And it's similar to what we've done before and haven't had any sort of pushback. So we'll expect that to be kind of the end of it, and we can sign off the final and finalise the fund strategy statement, and that would be that part of the project over. I don't know if there's anything you want me to, if you look at the fund strategy statement or not. If there's anything you want me to cover in more detail, but that was a kind of a quick summary of more about the background and why it's different this time and what it covers rather than the detail. There's quite a nice summary on page, your pack page, it's about page 8 of the FSS, but it's page 52 in your pack, which kind of sets out in a table the main elements behind the funding strategy when we've been carrying out the calculations to set employer contribution rates as part of the valuation. So yeah, that's the main elements. But I'll have to go into more detail if you want, or take questions.
It's really good stuff.
All right, I'm sorry.
So, thank you, Professor. Just a sort of question in terms of what goes into setting out contribution rates and the sustainability of that for our members to make sure we get a return. Just briefly touch on that.
So our approach is to look at, so one of the key assumptions is what we call the discount rate, which is a prudent estimate of the returns we expect to get, or you expect to get from the fund's assets. And the way we do that is we build up what we call the best estimate returns. So we look at the long-term expected returns for each asset class that you hold, so equities and property and bonds and all the rest of it. And then we run various models and look at various market indicators to look at what we think the best estimate return is. By best estimate, we mean there's a 50% chance of beating that return and 50% chance of being underneath it. So 5 out of 10 years you'd be above, and 5 out of 10 years would be below. And then we build up the best estimate return for the assets as a whole. And off the top of my head, that was about 6.5% per annum. Because we want to protect the members and want to protect the fund, we then make a deduction for prudence. So instead of having the bar at 6.5%, which is the best estimate return, we slice it off to get our what we call the discount rate, and that's a prudent estimate of the best estimate return, if you like, or prudent estimate of the long-term return. And that was 5% this time. So that weights that in the favour of the fund having a good chance of having enough money to pay all the members, and this hasn't when all the jurors actually the process. And there's lots of other assumptions that we set around CPI inflation, salary growth and longevity and so on, which I think we implemented maybe back in September. Very happy to get more detail on that, BB.
Thank you.
Thanks, Barry. Yeah, really helpful document. Actually, it's a good introduction to what we do. It doesn't quite tell us how to do it ourselves, but it's really helpful to just understand. Just a quick question in terms of discount rate going forward. How do you know how the Merton Fund compares in terms of discount rates to other discount rates that other funds have used?
Yeah, I'll answer that in two parts. In terms of the BW Universal Education Funds, which we look after about 22 English and Welsh funds, 5% pretty much right in the average of our rates, ranging from 4.7 to 5.3. So you're right in the middle of that. 5.3 is a bit of an outlier, as is 4.7. They're bunched around 5%. In terms of the wider LGPS market, there's a bit of a range there, probably, well, not more than before, but before actual firms that look after LGPS funds, from an actuarial viewpoint, use different approaches. And so those funds who use a gilt yield plus approach probably get a higher discount rate. They're probably up at 5.5 to 6%. Mercer, nobody from Mercer in the room, on that, but I'm not sure. I think they are slightly above us, but not much. They've got a more complicated approach, and they have a different discount rate for future service and past service, so it's more difficult to compare. I think it's got a much lower rate for future service and a slightly higher rate for past service. And then Aon have got a lower discount rate than we have. About the funds on all of is around 4.6, but they've also got a lower CPI inflation assumption. So Aon's the gap between the discount rate and CPI inflation for our funds is very similar to Aon, and it's probably not too far away from Mercer once you do all adjustments to get a comparable basis.
Thank you, Barry. So we're sort of in the middle of your.
Yeah.
Sphere. Thank you for that.
Thanks, Barry. Could you just tell me the next stage on it? We've done the valuation now, funding strategy between now and March. If you can just explain.
Yeah, so the funding strategy we've got in the pack still good draft across it,
Yeah.
but now the consultation period's over and we haven't had any challenge really, I think we'll reply to DFE, I think that'll be the end of it. We can now finalise the funding strategy statement and then we go on to draft the final, the formal valuation report and include the rates adjustment certificate within that report. So they say we'll do that over the next couple of weeks by the end of the month. And then that's the end of the project really. So then we can effectively complete it.
If I can just come in, just a reminder committee again, there's no change in the council's contribution rate. We can still continue to get, but the surplus we are able to keep it the same rate. And it will be very pleased to know the academic pool rate, it has come down.
That's correct, yeah.
Yeah.
So the council is exactly the same as before. Using up, I think we talked about this back in the last pension committee meeting where we had used up, we showed you the initial results. And the fund had used up a little bit of surplus to keep the rate where it was back at in 2019, kept it the same in 22, used up a little bit of that surplus. So the funding level had dropped from 109% to 105. That's okay, isn't it? Because we knew that was we've not got the surplus to keep the contribution rate stable. We're doing the same again this time, but because the primary rate has fallen, but the cost of the future benefits accruing has come down anyway, then you're using up hardly any surplus because the rate was certified almost the same as the primary rate. And no, actually right, when it comes to the academy pool, that those rates have come down by a few percent, so it's now much closer to the council rate.
Okay, yeah, is there any other business? Sorry, is there any other business? Okay, that brings conclude the first part of the meeting and result of the public excluded from the next session.